workshop. Again, we were meeting every Wednesday through the month of March, so this is week 3. We have another workshop next Wednesday as well, 10 a.m. Central Time. Your online registration link should include the access to all of those workshops. So again, you'll be muted upon arrival, but we do encourage any interactions or questions that you have, which we will cover at the end of today's lesson. So please feel free to chat those in at any time while you're thinking of them through the presentation. We will also send you an evaluation after each lesson. So if you could please include your name and email on that evaluation, especially if you want us to get back in touch with you to go over certain pieces of the workshop, that would be fantastic. And then we'll give you a certificate of completion once you completed all 4 lessons. So thank you for joining us. One last thing is I did send out the materials last night. Some of them were too large and they bounced back. So if you did not receive the materials for today's lesson, please chat that in the chat and I'll be happy to resend them to you after today's lesson. So without further ado, I would like to introduce to you my boss, Joe Kobel. Good morning, Joe.
Good morning, Kathy. Thank you. Thanks for everybody for joining us today for lesson number 3. We have some really good information again today with our third guest of the Life Workshop. And what I'd like to do is just go through the, Kathy, can you change the screen, please? So what I'd like to do is just recap last week's presentation by Wealth Management, Kelly Carter, which was the main presenter yesterday. And of course, we have Joyce as well, too, that are the main people for Wealth Management in the back. So, some great information there. The indexed UL, which I'd like to just briefly talk about a little bit, of course, annuities and in-depth studies, too, for one of the thoughts that I've had too, especially with all of the things that are happening in our social life and our business life and the economy today, is that there's a lot of uncertainty. And, probably now is a good time to talk with, re-engage with your clients, reconnect with them, pick up the phone and call them and talk about, their financial well-being, just to reiterate what they talked about last week on the webinar. About life insurance opportunities and emphasize our ability to go through wealth management in a box, and the crew over there, Kelly, Steve, and Joyce, to preserve their assets and do some sound planning during this volatile market. And of course, as well, Joyce is there to help too. So. Again, you guys did a great job on the webinar last week, and we certainly appreciate your participation. And so from there, I'd like to take it to the next level and introduce this week's guest. And it's Terry Plemer with Pekin Life Insurance. And Terry is our local rep out of the Chicago area, and I believe he handles Wisconsin too. So we're going to talk about other life specialists within Pekin that would take care of your particular area. Now, we do have some limitations with Pekin, and I'm sure Terry's going to cover that. Currently, I believe they do life insurance in 11 states, looking to expand further into our footprint as well. And I've talked to a couple of Terry's counterparts about other states, in particular being Pennsylvania. And they're also looking to do business in Utah as well as Nevada here in the very near future. So Terry's going to talk about a couple of different things: who needs life insurance, how much life insurance is enough, tools and resources to utilize and help determine how much life insurance, what products to use in various situations, and talk about the long-term care rider that they offer, still that's guarantee universal life policy, which is great. And then also the marketing materials that they have available, which are obviously no cost to you. So what I'd like to do now is introduce Terry Plemer, and thank you for joining us in our life workshop for week number 3, and looking forward to some good opportunities and information.
Good morning, Terry. Joe, a little bit of your voice was kicking in and out, but for the most part, we can hear your entire presentation. Just wanted to let you know that there was some audio kick-ins and kick-offs but we did get the message across for sure.
Yeah, and I'm sorry about that too. I'm working from home. We have no internet, no cable, no phone, so I'm working from my cell phone, and it's obviously intermittent. So there's a lot of issues going on in this country.
Right. Good morning, Terry. Are you able
Good
to?
morning.
You're good. Good morning. Thank you, Joe.
Well, to give you an idea what I do is I'm the life specialist for Pekin Insurance, and I cover Northern Illinois, the state of Wisconsin, and the state of Iowa. And I'll share with you at the end some of the contacts for you folks that are not in those particular areas that can do what I do to help you write some more life insurance. One thing I do is I work with independent agents throughout those states. And years ago, when I started on the marketing side, I decided to ask some of the most successful life producers I came across in this business that were in an independent system, what makes you different from everybody else? And one common denominator that I found above all else was the fact that each and every one of those individuals I asked said, well, I ask everybody I come in contact with about life insurance. And it's not the products that they had in their portfolio. It wasn't their years of education or anything as such. The most common denominator, again, was that they asked everybody they came in contact with about life insurance. So I always ask people, who are your prospects? And that's kind of a broad base type question, but basically everybody is your prospect, correct? What I find in the independent system is the areas that I think lacks the most is on the mom and pop sales. When folks call in and talk to you about their personal lines coverages, their home, their auto, and so on and so forth, a lot of times as agents, I find that in talking with agents, they feel like they're hurried or they're rushed, like they want to get out of that appointment and get on to the next one as quickly as possible. But my challenge to you is this. How long does it take to ask this question? When is the last time you had your life insurance reviewed? Now, again, you might not have time at that particular time with that prospect to go through the needs analysis or ask the questions and so on and so forth. But it's important that you lay the groundwork and let them know that you sell life insurance. So prospects, it goes from one end of the, from cradle to grave, basically, right? We have prospects of newborns. Newborns can be those, grandparents buying policies on grandchildren, or they can be, parents buying policies on children. And then we have the other end of the age spectrum where we do a tremendous amount of business in folks that are looking for final expense type policies. So your prospects are really unlimited. And what you folks have that most others don't is you've already got a trust relationship built up with your clients now. So if they put trust in you to write auto insurance or homeowner insurance, commercial lines business, why would they not trust you to write life insurance? One thing that comes up commonly is I have agents, when I talk to that person and they want to discuss life insurance, how do I know how much life insurance they need? Well, first of all, just remember there is no correct amount of life insurance, right? So in other words, if you wrote a person $1 million policy and that person passed, their family would probably wish they would have had 2 million. But it all comes down to affordability, as we all know. So how to determine the right amount of life insurance? Well, the one method that I use when I go out with folks and sit down with them is 7 to 10 times annual income. And I found this to work out quite well. It's not cumbersome. It's easy to communicate. And you find most often that one of two things is going to happen. When we do the 10 times spend down, and I'll explain that to you in a moment, I always ask the question at the end is, how do you feel about that? And I'll look at the spouse. If we're talking with the husband, I'll look at the spouse and I'll say, how do you feel about that? So keep in mind that life insurance is sold on emotion. So I want to ask a feeling question. How do you feel about that? I always tell folks that a rule of thumb for the amount of life insurance is 7 to 10 times annual income. Then I always preface it by saying, well, what I like to do though is I like to use 10 times because it's a round number. So for example, if a person's making $60,000 a year, I'll write that down on the top of a yellow, legal pad, and then I'll take 10 times that, which would be 600,000, and write that right underneath the 60,000 to provide a visual as we're going along. Then I'll ask them about, hey, do you have a mortgage? Yes, we do. Well, how much do you still owe on your mortgage? Well, we owe 150,000. I'll put a minus 150,000 in there and then do the subtraction and so on and so forth. I'll ask about car loans. I'll ask about any other debt. I'll ask about if they have children. Do you want to put money, set aside money for college education? So anyway, then I spend it down. When I get down to the bottom line, let's say, for example, in this case, that when we get down to the bottom line, after they spend down all their debt, the money for college education, there's $120,000 left at the end of the story. So I'll ask the spouse, how do you feel about that? Now, I've gotten all kinds of responses. I've had some spouses that will say, well, you know, if my house is paid for and my debt is all gone and there's some money for college educations, you know, I'm good with that. I'll have others say, I don't feel good at all about it. We need more. So keep in mind, in that scenario that I just gave, 120,000 would provide 2 years based on $60,000 of annual income of a normal standard of living for that spouse. So again, ask that feeling question at the end. How do you feel about that? Another method is a simple needs analysis. Now, I found that some agents use it and stop doing it. But again, some agents look at it as it takes time. It does, but keep in mind that when you're out there working with your prospects, you know, you want to be a professional. When you go into the doctor's office or dentist's office, do you want them to hurry through things with you? Answer is probably not. So take your time and do what's right for the client. So Pekin does, and this will be in your packet that Kathy will send out, a very, very simple needs analysis. And if you look at it, it's just family information at the top. You know, get a little bit of information about who their employer is. Do they have any current life insurance? And then also down at the bottom, what would they want for final expenses, emergency fund, and so on and so forth. Very simple, very easy. I do have agents that, you know, for example, if they're sitting in an appointment with folks and they just did their personal lines and they ask the question, when's the last time you had your life insurance reviewed? And there is an interest, they will provide this handout or brochure and ask the individuals to fill it out before their next appointment. So it's really a real easy type of thing to provide. It's not cumbersome by any means, but it does provide a roadmap to how much life insurance is actually needed. So now once we've determined the amount of life insurance, we get into products. And we have some very, very nice, very competitive products. We all know term insurance. We do have one product called Transitional Life that is one of our hottest selling products, and I'll get into that in a little bit more detail in a little while. We have the traditional whole life products and also universal life. So let's talk about term insurance first. One thing that sets Pekin apart from most of our competition is the convertibility of the term insurance. A lot of companies that are out there that are competitors might only allow conversion for the first 10 years of the policy. So what convertibility means is this. If I take out a term insurance policy today and I develop a serious health issue, for example, let's say I develop heart disease, well, my chances of getting life insurance at a standard rate in the future are slim to none. What convertibility allows is if I do develop that health condition, I can convert that policy to either a universal life policy or a whole life policy at the same rating classification as when I took the policy out. So for example, if I were a preferred risk or a super preferred risk, when I go to convert, I will get that same rating classification on my new policy, no health questions asked. Again, keep in mind, ours is convertible all the way out to age 75, where a lot of our competition might only be the first 10 years or the first 5 years of the contract. So if you are selling other term products out there, please make sure that you understand what the convertibility is. Another thing that's very important is that Pekin allows a partial conversion. So for example, if I sell an individual a $500,000 term policy and they decide they want to convert, they can convert all the way down to basically $25,000 of coverage if they choose to do that. They do not have to convert the full $500,000 of coverage. I want to share a little story real quickly. I got a call from an agent. This goes back about 6 or 7 months ago. And he called me up and said, hey, I've got a question for you. I think I know what the answer is, but I'm going to ask. My wife is 51 years old, and we just went to the doctor, and they diagnosed her as early onset dementia, and she's having mini strokes. And can I get some life insurance for her? Well, the answer is really no, right? Is once she's been diagnosed as having mini strokes, she's not going to be able to purchase life insurance. So I asked the agent, do you have any current coverage? And he said, yeah, we have it with another company. We have a 10-year term product. And I said, well, my best advice to you is call the company and find out what your conversion privileges are. Well, sure enough, it was a 10-year term, so he could convert it for the next 2 years. That's the good news. The bad news is he had to convert all 500,000 of it, and it was to a specific conversion product, which happened to be a whole life contract. So the bad news is that the agent told me is that there's no way we can afford to convert the full 500,000 to a whole life product. So if looking at that situation with Pekin Insurance, he would have had options. He could have converted a portion of that coverage and still maintain some coverage for down the road for his spouse. So again, these areas are sometimes overlooked when it comes to term insurance. I find a lot of agents that are just out there selling the cheapest term that they can sell just to make the sale. But again, in my opinion, I think these are two very important things that you have to understand and educate your client about. And again, our product, we don't have a specific conversion product. Ours can be convertible to any of our products that we have in our portfolio, subject to the face amount minimums. So for example, Universal Life, our minimum face amount is $25,000. Whole Life is $25,000. Simplified issue, we can go down as low as $5,000 on that. So that could provide a final expense type of policy. Transitional life. This is the one product I want you to become aware of and take a real serious look at. What transitional life is, it's a combination of term and whole life. And I think it's best illustrated if you can take a look at the illustration here. Transitional life has two components. It's on a term chassis, so it's going to work just like our term insurance does, 10-year, 15-year, 20-year, 30-year, or to age 65 guaranteed premium term. And then after that, what happens is there's going to be a whole life amount that's paid up forever. No premiums thereafter. So if you look at the illustration on the screen, for example, this happens to be a 45-year-old male, and the overall amount that he is taking out here is $250,000 for 20 years. Those premiums are guaranteed. And at the end of that term, when the term drops off, he's going to have a $50,000 paid up guaranteed life product. So if you look down at the illustration, 20 years pays $1,548 per year. As you can see in year 21, there's no future premium payments, and that $50,000 of coverage is going to stay in force till the day he passes. As you'll note in the far right-hand column, since there is a whole life component, there is a cash value component to the policy as well. So that cash value can be accessed via loan or through a full surrender of the policy. So for example, if this gentleman gets down to year 20 and decides, hey, you know what, my life insurance needs have gone away, I really don't care about having this anymore, he could actually cash the policy in and walk away with $21,750 of coverage. So where we see this being used most often is those agents that aren't real comfortable with maybe universal life and getting into the more sophisticated products. I am suggesting that they offer this as an alternative to the individuals versus just term insurance. Getting back to term insurance for just a moment, every statistic I've read out there, it's less than 3% of term policies pay out a death benefit. So think about all the term policies that are issued throughout the US, less than 3% actually pay out a death benefit. Why is that? Well, number one is most often people are outliving the guarantee period. So what happens with term insurance after the guarantee period is one of two things. Either the policy goes away, there's no renewability, or it becomes an annual renewable term, which means that the rates are going to go up drastically each and every year thereafter that guarantee period based on the individual's age. I call that the shock premium. Give you one example. Recently, I did a proposal for a gentleman that wanted to do term insurance, and it was a $3 million face amount. He was a smoker, 42 years old. Ballpark figure, $3,800 per year for that term premium for 15 years. He didn't think that was too bad. And so the question I asked the gentleman was, can you tell me today with 100% certainty that you're not going to need this in year 16? And his answer, of course, was no, I may need it. So then I showed him what the premium went up to in year 16, and it was a little over $54,000 annually for that same premium. So that's what I call the shock premium. So when you show people term products, make sure you show them what that renewal premium is going to be after the initial guarantee period. I go out on lots of sales calls with agents, and one thing I found is that a lot of folks, when I sit down and talk about their existing coverage and show them what happens to their term premium after the 20 years or after the 30 years, quite often I hear them say, boy, I didn't know that was going to happen. So now whether the agent told them 20 years ago or 30 years ago that that would happen or not, we don't know, right? But the reality is that's what happens to term insurance. So I'm a big proponent of having some type of permanent coverage in individual's portfolio so that there will be some death benefit there for their family in the future when it's needed. So again, I would offer that if you're going to show term insurance, offer plan B or option B and show the transitional life alongside. Now, a question I have quite often is, how much coverage should I show on the whole life? And my question, or excuse me, my comment back is, well, I would leave that up to the individual, right? So maybe they only want coverage for final expenses. Well, let's not think about final expenses today in terms of today's dollars. Let's think about what final expenses might be 20 or 30 years from now. So in this particular case, for this male 45, we estimated, or we chose $50,000. Now, again, hopefully final expenses won't be that in 20 years, but we don't know. If there is, if they are that much, we got it covered. If not, there's money to, pay back to the family. So take a close look at that product. I think you'll be pleasantly surprised in how successful you can be writing the transitional life. This is a flyer that Kathy will include in your materials. It's a nice little flyer that can be personalized down at the bottom in the white space there with your agency name and number, but it talks about using transitional life for mortgage protection. And it talks about, having cash value down the road, having a paid up policy and so on and so forth. So it's a real nice piece that, again, that addresses mortgage protection. Whole life. We have different types of whole life. One being preferred whole life, another is simplified issue whole life, and I'll get into those. One of the most popular areas that I see whole life being written is in CD transfers. What we find is that a lot of seniors out there have money sitting in bank CDs, and their only intention is to pass it on to the next generation. So, a couple things wrong with that, right? We all know where CD rates are at today, very, very low. Less than 1% in most cases, depending on the amount of the CD, of course. But again, it could be or it could not be, but depending on how the CD is set up, it could possibly go through probate. Well, here's a great way to take that CD money and do something better for the prospect. In this scenario, what I'm showing is the prospect had $100,000 sitting in a bank CD, earning very small percentage of interest, and they were just going to pass it on to their children. Well, we were able to take this happens to be a female age 65, and I just use a preferred rating classification, which is our standard rate. So that 100,000 turns into 184,000. Now, the other thing I did was I added our long-term care rider onto this. So up in the right-hand corner, you'll see that the long-term care rider is a 5% acceleration, and it will pay out 5% per month of the $184,000 of the life benefit. Now you can see that the single premium for that is $63.90. So that's a one-time premium, and that is included in that 100,000. By the way, it's not an additional premium added on to the 100. So it is included in the 100,000. So what that does now, for example, let's just take, for example, that $100,000 sitting in a bank CD, and let's say just for round number purposes, let's just say that assisted living costs $5,000 per month. Well, if we took that $5,000 per month and divided it into the 100,000, that would provide 20 months of long-term, or excuse me, assisted living coverage at $5,000 per month. Now we've turned in the 100,000 into 184,000. So now we provided a lot longer period of time for the assisted living cost at $5,000 with no additional premium going into it. So it's a great way to enhance a person's life insurance and or long-term care coverage by just simply using or exchanging dollars that are sitting in a bank CD for a life insurance contract. Now, you would be surprised also at how many seniors that we see that do qualify for super preferred rates, which is our next rating classification up on the underwriting tables. A lot of folks that may have just, for example, be taking medication for high blood pressure and or cholesterol, that does not disqualify them for super preferred rates. And recently, we had a gentleman that was 78 years old that deposited $100,000 into a single premium, and he qualified for super preferred rates. So again, there are opportunities out there to actually increase the death benefit based on their underwriting classification. By the way, what Pekin does is we always underwrite for the best rating classification. So most of the agents I work with, they like to err on the side of caution and say, hey, we think you'll probably fall into this rating classification. But when Pekin gets the application, we do the underwriting of it. What we do is if this person were to qualify for super preferred, that's the rate they'll get. Also, another important thing to keep about this single premium product is that we're only underwriting for the net amount at risk. So in this case, when they're depositing 99, or excuse me, let's just make it 100,000. When they're depositing 100,000 and the death benefit's 184, we're only underwriting for $84,000 of coverage. So in this particular situation, this individual would simply fill out an application, no medical exam required. Here's a nice little flyer that a lot of agents are using that have gotten some traction with it. As a matter of fact, I just had a call from an agent last Friday that sent one of these out to one of her current clients, and they called back and said, hey, we would like to do something. And so husband and wife were looking at putting between $50,000 and $100,000 of CD money into a life insurance contract to pass on to their grandchildren. So what's neat about this is you see about in the middle of the page, if the interest rate on the CD is 1.5%, it would take 50 years for that CD to reach the value of 101,468. So what they do is they take the value of that life insurance or the amount of life insurance, and that CD, it would take 50 years for that CD to reach that 101,468. Now, I put together a little spreadsheet that if you have a client and a prospect, you can be specific on it. So what you can do is you can enter the prospect's age, you can enter the prospect's amount of whole life coverage that they would be able to purchase for that CD, and get that CD interest rate and put in there, and then it will calculate specifically how many years for that prospect it would take that CD to grow to the life insurance amount. Once you show that to folks, it's pretty mind-boggling. So if you would like that spreadsheet, please let Kathy know, and I'd be happy to share it with you. Now, also on our whole life, we do have other, it doesn't have to be a single pay. We have what we call lifetime pay, which again, that's exactly what it says it is. They pay for their entire life. And then we also have limited pays. We have 10 pay, 15 pay, 20 pay, and 30 pay. So if they want to pay it up for a shorter period, take a long period of time to pay it up, they can certainly do that. If they want to shorten the duration to 10 years, they can do that. But we do also have those modes available as well. One thing about our product, as far as the whole life goes too, is it's a non-participating product, which means we do not pay dividends. So when you look back at this page, when you look at the cash value, what they see is what they get. So for example, 10 years down the road, this client knows guaranteed, no questions asked, that there's going to be $108,365 in that policy. It's not an interest sensitive type of product. It's just a fully guaranteed product. So once it's issued, there are no questions asked as far as what the cash value is going to be in the future. Now, I did not show it on this illustration, but the policy is guaranteed all the way out to age 121. This is the product that I used most often, Universal Life. I'm a big fan of it. I know Life got a black eye back in the early 80s and mid 80s and 90s due to the high interest rate situation, but those days are long gone. So what happened with Universal Life back then? I saw rates as high as 14% with one of our competitors at the time. And what was happening was that agents were illustrating it at the highest rate of 14%. What they failed to do was when rates went down is to go back and talk to their insureds and say, hey, rates went from 14 down to 7, down to 8. What we need to do is take a look at your product now and see what we need to do to make sure it's going to work the way you want it to work. Well, majority of agents didn't do that. They sold the product, walked away from it, and then guess what? 10 or 15 years later, clients are getting notices from the insurance company that, hey, there's not enough premium that you're paying right now to support the policy. The reason for that is they were assuming 14% interest, and then when rates dropped down to 8 and then continue to drop further, there was not enough money in the cash value portion of the contract to help offset rising costs of insurance. So that's what really gave the product a black eye in the industry. Now, if we fast forward today, we're at the really the lowest interest rate environment we've ever been with Universal Life. So I think it's a great time to sell it. And you know, the chances of rates going down much further are slim. Not to say they couldn't do it, but the chances in our lifetime of it going up at some point or I think, a lot better. Now, even if they don't go up and they remain constant, it's still a great product. And let me get into tell you why I think so. Well, I'm sorry, I'm going to go back one page here. The reason I love Universal Life is because of its flexibility. Flexibility meaning I can increase or decrease premiums. I can increase or decrease face amount. I can stop premium payments at some point down the road if I want to. So it provides those types of flexibilities that the other products I mentioned before do not. Term insurance. You know, I cannot go inside of a term contract and technically reduce the premium payments. I can't increase the premium payments. Whole life, same way. It's a static premium. What you see is what you get. You have to pay that premium for the life of the contract. Universal Life, on the other hand, works a little bit differently. It's a product that's funded properly, meaning you're paying the correct amount of premiums. You have the opportunity down the road, if things get a little bit tough, of backing off on the premiums and still keeping your policy in force. I use this product about 95% of the time in the sales situations I'm in. I personally own this product. I own it on my wife and my 2 children as well. And I'm a big fan of it. So, for example, when I talk to business owners in buy-sell situations or key employee situations, one thing I always talk to them about is this. Wouldn't it be nice if business revenue trends were always on an upward trend? But did you ever have those years when it went on a downward trend? All the time I get the heads nodding, yes, you know, up and down, yes, yes, we've been through those. My next question is, wouldn't it be nice to have a life insurance product that could adjust with those times? Get the nods again. Universal Life's that product. And once I sit down and show people and educate those folks as far as how it can work for them, it's typically a no-brainer on what product they're going to go with. Again, I'm a big believer in offering options. If, for example, the affordability isn't there, then we can do a lot of different things. We can back down on the amount of Universal Life and include some term insurance. But again, getting back to it, it's all about affordability. But I like Universal Life for that particular situation. Mom and pop situations too, I find it works out great. But let me get back to business owners real quickly. If you're selling commercial insurance and not talking to your business owners about business perpetuation or key employee insurance, or buy sell, for example, same terminology for business perpetuation, you're missing a great opportunity. I would challenge you, if you talk to 10 of your commercial clients, 9 of them probably do not have a properly either structured or a properly funded buy sell agreement. And right now, even though the markets are down and so on and so forth, the fundamental basics of the economy are still very, very strong. And what I've found is that business owners, when you can show them value versus price, they'll choose value every time. And I think that value comes from Universal Life because of all of its flexibility. I just was on an appointment Monday where we closed a case for $107,000 of annual premium. That particular case, the business owner had no life insurance in place. and we talked to him. That was our third appointment. The first appointment we had was a fact-finding mission. Second appointment was we went back and talked to him about numbers and so on and so forth. But he went from 0 life insurance to paying a $107,000 annual premium for a universal life contract. Now, why would he do that when he could buy term insurance, which would be a heck of a lot cheaper? Well, a couple reasons. Number one is the main reason for the life insurance, of course, was that if he passed, he was not married, had no children. He wanted his office manager, who he had a friendship with for a number of years, and her son, who was actually working in business, to acquire the business. He didn't want them to have to worry about being able to purchase it. He didn't want them to have to worry about any taxation, so on and so forth. That was the need for the insurance. But let's fast forward to about 15 years from now. Let's say, for example, they don't buy the business. He's still alive. He sells it to someone else. Well, now he's got all that cash value built up in the life insurance contract to be able to use to support his retirement. So that was what really attracted him to using universal life. So let me show you. This is just an example. This is a real live case I just did recently. This gentleman was 61 years old. He had no life insurance. Well, take that back. He had some term insurance that was going to be expiring in about a year, and he was concerned with what's going to happen after that. So one of the discussions that I always bring up is, do you have a concern about long-term care? His answer was yes. And the reason for that was his big concern was his wife was just diagnosed with cancer not long ago, a very aggressive form of cancer. And he said, I don't think that she'd be able to take care of me if something happened. So what I showed him was this scenario. And this was a business owner, by the way. It doesn't matter that he was a business owner because it wasn't being used for business purposes. But here's a business owner that had no, he had no permanent coverage whatsoever, no long-term care. So in looking at this coverage, $1 million of coverage, and our maximum long-term care amount right now is $350,000. And as you can see, it shows 5% there. That's the acceleration amount per month. So in this case, he would be able to access 5% of 350,000, which is 17,500 per month for long-term care purposes. Now, keep in mind, long-term care categories that would include nursing home, assisted living facility, home health care, and then we pay half of that amount for adult daycare. So you can see there that the annual premium for that rider is $630 per year for the rider, compared to a standalone long-term care product. That price is very, very, very competitive. Now, what that will do is, if he were to receive benefits for long-term care, is reduce the face amount of the life insurance dollar for dollar. So, for example, if he used up the long-term care amount in past, then his family would get $1 million less the $350,000 of coverage. So the industry has gone toward this model, and it's been very, very successful. I would say I have more interest in this long-term care rider than I've ever seen before. The great part about it is this. One thing I talk about, for example, this gentleman, I said, you know what, his first name was Bill. And I said, you know what, Bill, I hope you never need to use long-term care. And here's the great news. If you never need it, you've still got $1 million to pass on your family. Or, if he wants to cash it in at some point in time and say, hey, I no longer need this insurance, he can certainly do that. By the way, in this scenario, after 15 years, if he wanted to stop paying premiums, the interest in this product would self-support, would help fund the cash value, and the interest would self-support this policy, meaning he could stop paying premiums in 15 years, and this policy would run to age 121. So a lot of flexibility of this product. He can do lots of things. He might get down the road and say, hey, I no longer have a need for $1 million of coverage. Let's drop that down to 500,000. He can do that. He gets down the road 15 years from now and says, hey, I no longer want to pay premiums. He can do that. He can't do that with a term policy. He's got to pay those policies. Here's the other great thing. After 20 years, for example, if he were to purchase a term policy, he's not going to get that shock premium. He could stop paying premiums, or he knows his premium is going to be 26,502, just as when he started out with the policy. So if you're not familiar with this product, I would strongly suggest and encourage you to become comfortable with it. That's where I can come in to help, or other life specialists can come in to help to make you feel comfortable with it. I always tell agents when I get into a training situation or educational situation with them, if you can understand the universal life, everything else is really, really simple. Again, don't, I'm showing a lot of larger cases today, but keep in mind that everything I talk about today, it doesn't matter the size of the case because the folks that you're talking to have the same needs, right? So for example, this business owner, even if he only needed $100,000 of cash, life insurance, the 100,000 to that person is the same as $1 million to somebody else that has different means. So don't think that us life specialists can't help you with the smaller cases. That's what we're here for. But quite commonly, we're running into cases like this, and we are working with business owners in some of the more sophisticated cases. But that's the beauty of doing what we do, and what Pekin can do is we can provide you that assistance and resources. Again, this is a nice little flyer that can be sent out. It's not real wordy. It just kind of talks about what's available for the long-term care and so on and so forth. And again, it can be personalized down in the lower right-hand corner. What products to use? This is one comment or question I get quite often. How do I know what product to use? Well, again, I would always talk about some permanent type of insurance in a person's portfolio, whether it be universal life, whole life, or using transitional in a portion of it. But let's go to juveniles. Juveniles, basically, there's two products that we have available. Number one would be universal life. As I mentioned before, I took those on my boys when they were quite young. And number two would be a whole life product. So whole life, again, it can be a single pay if a parent or a grandparent. We see grandparents quite often doing single pays where they do a one-time premium and it's paid up for life for that juvenile. Or it can be a 10 pay. We see a lot of parents doing a 10 pay whole life on whole life. And after 10 years, no future premium payments, guaranteed paid up for life. One misconception that I always get too is I have agents call me and say, hey, I got a parent that would like to take out a universal life contract on their or life insurance policy on their child and use it to fund college education. Well, the problem with that is because of the amount of money going into the life insurance contract and some limitations on how much can be written on a juvenile, that's really not going to get the job done. And we all know what's happened to costs of college educations. So if you do have those parents that are concerned about that, talk to the parents about putting a universal life contract on their life instead of the juvenile's life and use that to fund the college education. A couple different reasons, right? Number one, they can put more premium dollars into it and grow larger cash values. Number two, if that parent dies, now there's life insurance available for that juvenile to help complete that college education. So again, the question I asked individuals is, what do you want to do with that life insurance for the juvenile? Do you want it to build cash value down the road and something you can turn over to that individual and have some flexibility to continue the product on? Or do you simply want a product that's going to provide a death benefit protection and you can pay it up in X number of years? So that's how I boil it down to what works best for juveniles. Mortgage protection, quite often we see term insurance, right? Person has a 30-year mortgage, we sell them a 30-year term product. But again, I would also offer transitional life with a paid up portion at the end. And also I use universal life as well, and showing how that they can fund a universal life contract and use the cash values to help maybe prepay their mortgage down the road when that cash value gets built up. So 3 different products that you can use in that situation. Rarely do I ever see whole life being used for mortgage protection. Not to say it couldn't, but I don't see that used very often. College loans. Again, I can tell you a story of an individual that I called on, an agent. His brother was actually his niece. She went down and volunteered at Katrina. She was going to college in med school and so on and so forth, went down to Katrina and volunteered, got home, contracted some type of event down there, and passed away within 6 months. Her mom and dad had co-signed on her loans for the tune of $250,000. And guess what? We all know who's responsible for those loans, right? Mom and dad. So make sure that if you're talking to clients and they have a son or daughter in college and there are loans involved, make sure that you talk to them about life insurance on that child. Again, what type? It can be term insurance if they want to go to cheap route until that loan's taken care of. Or again, universal life works very, very well in that situation, is that it can build equity. They can turn it over to their child if they want to in the future and give them a boost or a head start toward their mortgage protection insurance. Commercial clients, where I spend most of my time is working in that market with agents. Business succession or buy sell is another terminology for it, or business perpetuation, and then also key employee scenarios. Right now, with the job market being as tight as it is, I'm finding that owners really want to keep their key employees. And so what we can do with Universal Life is we can structure situations to help that employer put a carrot out there for those key employees. For example, two recent cases. One was I had a key employee that was 35 years old. Employer said, hey, I'd like to really provide some type of bonus for him. So basically what you look at in key employee situation is this. There would be a loss to that business should that key employee pass. So that's the primary reason for the life insurance. Secondarily is that you can set it up for a bonus structure. So in this situation, what we did was we set up a life insurance product amount of $500,000 using Universal Life. And the employer said, hey, I'd like to provide a bonus to this individual every 3 years of about $5,000. So in year 3, we structured it so that the employer could pull out $5,000, hand it to their key employee and say, hey, you're doing a great job. Keep up the great work. We really appreciate all you do for us. In year 6, that employer can pull out $10,000, hand to that key employee and say, hey, great job. Keep up the great work. Proud to have you here. Year 9, 15,000, year 12, 20,000, et cetera, et cetera. So great way to offer that employee a bonus. And also, by the way, that scenario, in that illustration, because of the way we funded it, at age 65, that key employee, there was still $322,000 of cash value that was available for that employer to do as he or she chooses. For example, that employer may say, hey, I've already paid out $180,000 of bonuses. I'm not going to pay out any more. I'm going to cash the policy in and recoup all my bonus money I paid out. Or number 2, he or she could say, well, you know what? This employee has been so good to me. I'm just going to turn this policy over to them, and they can use that $322,000 to supplement their retirement. So lots of options, lots of ways you can mold that product to fit the situation. Another one I did recently, business had a 26-year-old individual, and that employer wanted to have $500,000 of cash value available to that employee as a bonus in 20 years. What a great thing to do, huh? So we set up Universal Life and we funded it so that it would provide that type of cash value available in 20 years. Now, guess what? If that key employee walks away, the employer owns that policy, so the employer can do as he or she chooses with that policy. Cash it in and take the cash value, or they could simply continue paying premiums until the day that key employee dies or that individual dies, and then recoup the death benefit. So they do have options. But now getting back into business succession planning. This is one area, if I were selling commercial insurance and I wanted to sell life insurance and make some very good money at it, this is one area I would focus on. And again, business succession planning is simply this. If you died last night, what happens to your business? A lot of times they have nothing set up. Give you one example. Well, let's talk about this. What happens when that scenario happens? There's no plan in place. Typically what we see is businesses are sold for pennies on the dollar, right? It becomes a fire sale. I have a friend that's in the auctioneer business, and he would tell you when it comes to farms and businesses, he sees that quite often when he's involved in the auctions, is that there's no plan in place for anybody to take over. Spouse might be there, can't run the business, and say, you know what, let's sell it. One of my personal situations, one of my best friends owned 2 successful businesses. He got a call from his accountant one day and said, hey, Dan, do you know anybody that'd like to buy a small manufacturing business? And Dan said, well, tell me a little bit about it. Well, the manufacturing business made outdoor furnaces, husband and wife ownership, and roughly 28 employees, and no family in the business. Husband died at 63 years old of a heart attack. Wife says, you know what? I can't run this business. There's nobody here to take it over. I want to sell it. She was asking $1.8 million for the business. My friend went up along with the accountant and toured the business and sat down and had a discussion with Mrs. who owned it. And on the way home, Dan said, you know what? I'd like to make an offer. The accountant asked what that offer would be. Dan said $750,000. The accountant laughed at him and said she'll never take it. Dan's comment was, well, I don't need the business. That's my offer. The accountant called her the next day, put the offer on the table, and she accepted it. So Dan bought a $1.8 million business for $750,000. Now, fast forward a little bit, he acquires the business. They went and did an inventory. They found another $500,000 of inventory that was not accounted for in that $1.8 million asking price. So he basically got a $2.3 million business for $750,000. So I always tell folks the moral of the story is this. If Mrs. would have had an adequate amount of life insurance on her husband, what could that have bought her? And the answer is time, right? So it could have bought her more time where she could have hired somebody to manage the business until she got the asking price that she was looking for. So again, quite commonly, we see in small businesses that they just don't take the time to sit down and do this type of planning. So again, it's any business that you're dealing with. Partnerships, we hear partnerships most often. And I always ask this question, hey, if you died last night, would your partner want to be in business with your wife? And typically, the answer is no. Then it goes to, what about sole proprietors? I get that often. Well, this can't work for sole proprietors, right? Well, yes, it can. And what I suggest there is talking to that sole proprietor about, number one, if they have a key employee. If they don't have a key employee, the number two would be to ask them if they have a friendly competitor. For example, what about a body shop down the street? Or maybe they're on the other side of town, or maybe they're in a community 9 miles away or 10 miles away, but these guys are buddies or friends. I'm just about willing to bet you that body shop owner in both those locations do not have a buy-sell situation set up. So you could set one up, help them set one up between each other that will provide for the value of the business upon either one of their deaths. So again, take the time to look into business succession planning. I had a gentleman that's he was 27 years old at the time, but he came to one of my life classes, and we talked about business succession planning. And I again preached that, hey, you need to talk to your folks out there. And I said, you don't have to be an expert. All you have to do is ask this question: when is the last time you had your buy-sell plan reviewed? It's not a yes or no question they can answer to, right? But it lays the groundwork. And most often what you're going to say is, well, you're going to hear is, well, we don't have one, or it's been 15 years ago, and so on and so forth. But this young man asked that question, and he ended up introducing me to one of his commercial clients, and we ended up writing a case. We closed it in November this past year. It was $129,000 of annual premium. And all he did was ask the question and put me in front of the prospects. So that's where your life specialist can come into play and help you, and so on and so forth. But don't be afraid to ask that question. When is the last time you had your buy-sell plan reviewed? And then lastly, we have the final expense scenario. So final expense, typically what you're looking at there is a lot of times folks will want maybe a $10,000 or $15,000 policy for, to cover the cost of cremation or a burial. And so final expense, we would have simplified issue available there, and that's going to be for your more healthy clients. And then we do have a product called Graded Whole Life that is for your very unhealthy clients. Now, I'll throw up a red flag a little bit on the Graded Whole Life. If it's an individual that's probably 65 years old or older, it becomes quite costly. But where we see it being used quite commonly is we have people that are in their 40s or 50s that might have type 1 diabetes or heart disease where they can't get coverage and they want a final expense policy. It works out great for those folks as far as a Graded Whole Life goes. Also, we do have a irrevocable assignment to the funeral home that can be used on these smaller final expense policies that will protect that policy from Title 19 spend down. So, and again, we can help you with that. So what I'm going to do is just kind of this last slide is who is available to you in your areas. Myself in like I said, Wisconsin, Iowa, Northern Illinois. Ryan Hallam is in Central and Southern Illinois. John Turner in Indiana, Ohio. Carol Neese in Arizona. And then David Knight is technically not, he started out as a life specialist, but he took another position as a regional director with us. And he's in the states listed below. Excuse me. And as Joe had mentioned, we are continually opening up in new states on the life side. So Kathy, with that, I guess I will turn it back over to you to see if there might be any questions that I can answer.
Yes, thank you. If anybody has any questions, please chat them in. I did have several folks that did chat in that are interested in that spreadsheet, Terry. So if you could
Fantastic.
send that to me, that would be great. And I'm going to attempt to send all of the materials in a few emails because some of them were quite large. So if there's any other pieces of information that you'd like to see, that would be great, material wise. And I'm gonna show that slide again, so I'll go ahead and take that back. Thank you, Terry, and Joe, I'm
Kath,
sure has some
yeah,
additional questions.
I wanted to jump in a minute too, Terry. Just a terrific job, a ton of information, covered a lot of ground in a short period of time, and we certainly appreciate that. You know, and some of the things that we've talked about in all of these presentations so far is tell the story, you know, and that's what a good salesperson does. And you certainly heard Terry tell numerous stories on this call today, and just a wonderful job. Certainly appreciate that. A lot of different opportunities for all walks of life there, as we know. So, Terry, again, great job, terrific. I appreciate you.
thank you, Joe. And one thing I
Yes,
forgot to
Terry.
mention, Kathy, if you might send that out in an email too, is us life specialists, we do not split commissions. So when we go out and help you agents on a case, we do not take any of the commissions at all. So I just want to make sure everybody's aware of that as well.
Okay. And
You know, one last thing I'd like to add too. One thing I'd like to add too is Terry. I know that you also have trips, a couple of trips, and if you could just expound on it, because I know it's a ever moving target, and every year the number goes up because it's sales. It's a sales organization, and the cost of doing business goes up every year too. So if you could just talk about that, and then I can just jump back in on a qualifier. So if you could just tell them what it takes to qualify for the trips, and I do want to tell you from my own personal experience, if you've ever been on a Pekin trip, you certainly don't want to miss going on one the next year, because they're just awesome. So go ahead, Terry.
Well, thanks, Joe. Yeah, we have basically 2 trips available each year. One is a fishing trip to Canada, and the other is what we call our scenic trips. The fishing trip to Canada is typically in the summer, in July, and the scenic trip is in November. And we have several different dates available in November. But our next scenic trip is to Hawaii. We're celebrating our 100th anniversary of Pekin Insurance, and so we're doing it up big, and it's going to be in Maui next November. So the great news is right now is, you're in the qualifying time for that particular trip. Or if you're not interested in Maui, you can certainly use your qualifications for a fishing trip to Canada, which are second to none. So in order to qualify for those trips, it takes $14,000 of annual premium to qualify one person. So one person is one trip. So for example, if you wanted you and your spouse to go, you would need to write $25,000, and that would get you and your spouse or your significant other to Hawaii or the fishing trip. So $14,000 of premium for one, and $25,000 for two. Now, here's the other thing I want to make you aware of. If you write a single premium whole life, we don't base it on, what we do is this. Let's say, for example, I used that $100,000 case before. That we don't do on a single premium. We don't apply the 100,000. What we do is we use 20% of that amount. So 20% of 100,000 would be 20,000. So that would qualify you for one person, and you simply need to write 5,000 more. And we can get into those nuts and bolts later on. But just keep in mind 14,000 and 25,000 for two.
Terry, real quick too, on the fishing trip, wasn't there like 125 points needed? So isn't there a little more premium than that, or is it still the 14?
The key will still get you there, Joe. The points are a little bit different as far as that goes, yes, but a key can still get you the fishing trip.
Oh, okay.
So if you want to share those if you want to send that to me, Terry, I'd be happy to get that out to all the folks here as well. And then I do have a question here with Eric Ash. Eric, good morning, Eric. Did you have a question? I saw your hand raised. I think you got to unmute yourself. There you go. Good morning. I don't hear you yet. Do you want to chat in your question? If you want to do that, that would be great. I'm not sure why it's not working, but while we're waiting for Eric's question, here's the list of materials I wanted to make sure you all received. So I did resend the flyers this morning, the mortgage protection plan, the business perpetuation catalog of products, and the whole life. I'll get the My Memorial Guide and needs analysis out again. I know we sent them out with lesson one, but I'll get those out again. Also, the sample illustrations as well. Terry was kind enough to share those with us as well, so I'll get those out to you as well. And also, Terry, you'll send me that spreadsheet, so I'll get that out to everybody as well too. So Eric's question is, what's the new normalcy with life insurance, specifically in the short term around medical testing, pyramids, underwriting, etc.?
Yeah, right now, it's excellent question. One thing that the Pekin is coming up with, actually coming up in probably by the end of June, is we're going to have available the actually almost an instant issue. It will be an instant issue life product. It's going to be basically our term and transitional life, and it'll be up to face amounts of 250,000. But what we're seeing is the industry is going more and more to analytical, using analytics in the background. So, for example, with our new product, with our new software coming out, our system coming out at the end of June, as you're sitting there with a client, as long as the face amount is 250,000 or less and it's term or transitional, you input the information. As you're inputting it, it's working in the background doing analytics and so on and so forth. You hit submit. In a matter of seconds, it will say yes, approved, or no, need further underwriting done. So you can actually print out a policy right there on the spot if you want, or you could send it digitally. Right now, we're still doing oral fluid exams on basically people up to age 40, less than 500,000 of face amount. With a new instant issue, I know, of course, we're getting away from that, and we're hoping with analytics and so on in the near future that we can eliminate some of the exams. I will tell you, on large amounts, we've gotten away from doing treadmills. We're doing blood tests now, so we are looking at ways to make it easier and easier.
Thank you, Eric, for your question. Thank you, Terry. Anybody else have any other questions? I didn't see any others chatted in. I know we're just past the hour here, but just keep in mind, we'll look forward to seeing you all next week, talking about driving business to your agency, and also about tracking sales in the management system. We will send you an evaluation as well after today's session. So if you could please give us your feedback, that would be fantastic. So Eric does have another question. What impact in short term do you see with the COVID-19?
Oh, that's an excellent question. Matter of fact, I just had a conversation with one of our underwriters this morning, and right now it's business as usual. For example, oral fluids, we're still asking agents to do oral fluid exams, oral fluid swabs, and he got message from Paramed Services that everything is still good there. So right now, again, one thing to keep in mind is that right now, it would take a drastic number of deaths to move the mortality table. So we don't foresee that happening. But I would say this: you might get to the point where it could slow down the process, as far as, for example, if you have a lot of paramedics, nurses that are concerned about going out and doing the exams and so on and so forth. That could slow down the the train, so to speak. And then the oral fluid, we're kind of reevaluating that as a company too, is what can we do there? Are we going to, instead of having an agent do an oral swab, are we going to request that a paramed exam be done? So those are some things right now, but there's still a gray area out there as what actually is going to happen.
Excellent question, Eric. Anybody else have any other questions? We'll hang out here for a few extra moments if you do. Again, have a great day, weekend. Stay safe, stay healthy, everybody, and look forward to seeing you all next week. Terry, great job. Joe, thank you again for putting this workshop on for everybody. So thank you all. Look forward to seeing you all next week. And congratulations on completing lesson 3. Great information, Terry. Thank you so much.
Thank you, Kathy.
I look forward to receiving your additional materials, and I'll be happy to get those out for you.